okay? Chapter 5 and 6 both deal with business income for the Schedule C. 5 is going to talk about general business income information, cost of goods sold, business expenses. And then 6, we'll talk some more about depreciation and some other things that on the Schedule C. All right. Basically, Schedule C, just a variation of the Schedule E that we talked about. We're going to have a section for income, and we're going to have a section for expenses. Now, what each one of those lines and the things that we have to do on there are going to be different, okay? As it says on 5.3, it talks about all the different types of businesses that you can run into, okay? We're going to be dealing with sole proprietors, all right? So if you go to 5.4, it talks about a sole proprietor where an individual owns a business, often a small business. Doesn't necessarily have to be, and we'll talk about that too. But other business structures allow multiple owners, the partnership, the limited, the LLC, limited liability corporation, S Corps, and C Corps. Those are all going to go on a separate return, what we talked about with the Schedule E, and come over on a K1. Sole proprietors, just as the first word says, by yourself, okay? You can have a sole proprietor per se concept, as it talks about at the bottom, that is a qualified joint venture. That's a husband and wife together. Because they're married and doing married filing joint, they can still go on a Schedule C. They don't need to do a partnership return unless they don't get along very well and there's something that needs to be done as a partnership. Okay? So in Liz and Brian's case, it would probably be done in a partnership because Liz wants to own 51% and Brian only gets 49. Okay? What's that? Okay. Yeah. So in that case, we would have to do a partnership because they need to have their ownership. Okay? But in a typical case with a married filing joint return, you can have that sole proprietor. All the other partnerships are done on that 1065 as it talks about there. Okay? Schedule C versus Schedule CEZ, okay? Obviously, you know, we'd like to do everything in an EZ. We'd like to do our return on an EZ, okay? Long before, Mark can attest to this, but long before most of you are born, income tax returns are basically done on a postcard. You know, you just kind of said, here's my income, bill me. So, all right? Didn't have all these lines and all these forms and everything. They were much, much easier. All right, not trying to date you, Mark, but okay. All right. Schedule C versus EZ. If you go to top of 5.5, you see that little thing. We have talked about the CEZ before. You have to use a CEZ. You know, there's certain limitations or restrictions, whatever you want to call it, and you cannot have a loss, okay? So if somebody has a business where they just have income and really their only expense is mileage and maybe a couple other things, CEZ is fine as long as it meets the restrictions that you see there on the top and is on the software itself. Even though that's the case, I encourage, and I tell everybody, and I tell my students and everybody in my office, do it on a C, okay? You do that return or that form on a C, and then if you need to, because they had something simple, you can always charge them on the CEZ form as far as the rate. But on the C, it's great for you starting out because why? It has all the single lines and you're able to interview them and ask them the questions, okay? Because if somebody says, oh yeah, I'm a driver, I made 5,000, I drove a certain number of miles and I had to get a special driver's license to do it. Well, sounds like a CEZ as long as it meets the income restrictions, okay? But on a C, you might be able to ask them, well, whose car are you driving? Is it yours? Well, you know, what other expenses did you have? Did you have to wear a uniform? Did you, you know, it allows you to think about different questions that you can ask them to get details, okay? Accounting methods. On the form, we're going to see the different accounting methods. You know, the cash, accrual, or other than those. Most of the time, we're going to use just the cash basis, you know, even for inventory, okay? we'll use some different scenarios there where we talk about that, but not necessarily. If you look at the Schedule C on page 2, cost, okay? If you have inventory, yes, you could use the accrual, but most of the time with inventory, you know, you're going to use the cost basis or the cash basis, cash method of accounting on there, or the other, kind of a hybrid, okay? Most small businesses don't have enough inventory to worry about it. If you have a warehouse full of stuff, chances are you should not be on a Schedule C anyway, because, you know, with the accrual and carrying over on that. So, okay. Estimated taxes, it talks about that. The biggest reason for estimated taxes is you got to remember, whatever your profits are on your small business, you're paying Social Security and Medicare on your tax return. And those are calculated after the credits that eat up your tax bill. So if we look at 1040, page 2, okay, so I've calculated my tax, okay, and in this case I had a child tax credit that ate up my tax bill. But if I have self-employment, my tax bill returns, okay? And what does not happen with self-employment? What do you not usually typically have done? No withholding. I have no paycheck. So the way I have to get that withholding done is having to do it myself, and I would have to pay estimated taxes. Now, you can have college credits and all the refundable credits that might eat up, you know, in this case, an earned income credit that would eat up any tax that's being generated by the self-employment. Okay? And that's why you've heard me say that it's amazing the number of people that cut hair in their basement for about $10,000. These get a pretty good return because they got some expenses. It's earned income. The earned income credit covers the self-employment tax, and they got a good refund. Okay? All right. And they got 3 little kids to clean up and sweep. All right. So they end up pretty good on the return. Okay. The other thing that's important with being in business is that you are materially participating. Okay. All right. Noel, do you know what the restrictions are for that? No, not as much that, but the IRS likes to collect taxes, right? So what does your motive have to be in your business? Make a profit, okay?
Most recent, or 5 out of 7, and then 3 out of 5.
3 out of 5, yep. Okay? So, you know, you can't be showing losses for 5 straight years. Yep, then you're not really trying. Okay, it becomes classified as a hobby. And the IRS would probably say,
So they agree that it is not, it is a business, and they give it out.
so, you know, the other thing that basically what we need to make sure on too is obviously there can be extenuating circumstances, you know, and that would be something that you would have to explain. All right. So we have that with the business on there. Okay. So you have to be actively participating in it. Now, the way we're going to do this, let me just touch on real quick. At the bottom of 5.7 is the explanation of a statutory employee. All right? Statutory employees, as it says on the bottom of 5.8, which is great after you read all this stuff and trying to figure out what it means, right above the little W-2 form it says, a statutory employee won't be encountered very often. Okay, so great. So I just read a bunch of stuff that really doesn't matter. But they waited to the end to tell you that, okay? It'll show up on a W-2, and the big thing to remember is chances are there's no withholding, okay? Now, just because you see a W-2 that has no withholding, doesn't think that you automatically have a statutory employee. the little box has to be checked on the W-2. Okay? You will see W-2s where people will go exempt. They don't have anything withheld. And you see that quite often when there's a return that has a large earned income credit, because they want as much money in their paycheck because they know they're still going to get a big refund. Okay? So just make sure on that. Basically what it is, when you look at a statutory employee, the most common one that you might ever see is back on 5.7, the second one. A full-time life insurance sales agent whose principal business activity is selling life insurance or annuity contracts or both, primarily for one life insurance company. Okay? That's just the way their structure's set up. As it says on the help box, the statutory employee is an employee for Social Security and Medicare tax purposes and self-employed for income tax purposes. So basically, they kind of have the best of both worlds because they're going to pay their Social Security and their Medicare on their W-2, but you're going to have them pay their income tax on their net profits on their Schedule C. Okay? Don't see these very often, but it's similar to what we're going to see when we talk about clergy. Because clergy really don't pay Social Security ever on their tax return, but they're not self-employed. The reason they don't pay Social Security because most of their compensation is their housing allowance, paying for their housing. Okay? All right. Business income and expenses. Schedule C, we're just going to go right through the form, kind of like we did the Schedule E. We'll talk about the different ones, okay? And that's kind of the way the textbook does it. You have to come up with whatever your principal business. What are we participating in? Business code, okay? You can look those up in Quick Finder, which is exactly what you see in your textbook, okay? Or if you're a person that likes to use the computer, you can go in there and hit F1, and then you go in there. I hate doing that because the reason is if you go into the business code box on the top right of the Schedule C, and then you go into the little help menu, it says click here for a list of business codes. Come on. Then it just gives the headers. Now I got to figure out, and then I got to start scrolling through. Yeah, so I'm not big on that. I'd much rather have the little sheets that's in your book or just go to the Quick Finder. But you do now need to find those codes, and as close as you can. All right? It used to be the case that the IRS was not worried about you just putting in 99999 as long as you talked about what the business was. They don't like that anymore. They want you to find the code, okay? Business name, the address. If it's somebody's sole proprietor, they're running out of their house, typing in same there is fine because it's just basically out of their home. We have the accounting method, okay? We talked about that. Now, obviously, it's very important to them because they ask you the question, did you materially participate? Well, did we? You have to decide that, okay? And then they ask a question, if you started or acquired this business this year. Did you make any payments in 2015 that would require you to file Forms 1099? Backing up, previous question. What do you think they're asking that for?
You have the employees?
No, the one about if you started or acquired the business this year. Yeah, to start the clock on what? The 3 of 5. Yep, okay. All right. And then 1099s, just as Mark said, are we paying anybody to work for me? Very common with the sole proprietor. I have a gentleman that has a couple tractor trailers, moving trucks, moves people all over the country, kind of an executive type mover. What he does is he has connections in the cities that through whatever organization he's a member of, calls and, 4 or 5 guys meet him at the street corner and then help him unload the truck. And he just pays them, gets their information, then he issues them a 1099 so he can write it off. They're not employees of his. He's not dragging them in the truck all over the country. They're just contract labor that he uses at that time. I'm sorry, I can't understand.
Is there like additional credit or deduction that if you have a W employee, just an additional credit? Is that
Well, yeah, employees always get the credit for paying payroll taxes. As far as, you know, as far as on the Schedule C,
but like if you had like
yeah, there's additional for payroll taxes that you can do on there. Okay. Most of the time, though, when you get into payroll taxes, you're better off being in a corporate, like an S corp. Okay. So, the thing about the sole proprietor too, most of them are going to be smaller businesses. You know, Mary Kay cosmetic business that they're running out of their home, whatever. I had a client that was a dentist, and he started to grow his business. And actually, in the adjacent town, there's another practice where the gentleman's retired and bought it. Well, it got to be the point that we were doing tens of thousands of dollars in estimated payments because all of a sudden his business just took off. Well, we sat down with Maria at the corporate office and we got him out of there, put him on an S corp. He was the sole stockholder, so he could sit at Tim Hortons and talk to himself and have a board meeting and write it off. Okay, you can. If you have all your stockholders there, that's a board meeting, right? Okay, if you're the sole proprietor or the sole stockholder, okay. So if he sits there and, you know, discusses business with himself and makes a corporate decision, that was a board meeting. Okay. What's that? Yeah, we asked that you have it recorded. So you got to put your little thing on your cell phone and do your own little Facebook Live thing and prove it to me. Okay. All right. But what I'm saying is that you get so big, then, you know, he was getting killed. You know, he was paying tax, personal income tax, and also he was in a much higher tax bracket. He was also paying his self-employment tax with his Social Security, Medicare, and all these things like that. He had a couple employees, so we had some things like Noel was talking about that we could do with his payroll. But he was getting killed, you know, because all of a sudden he's got, you know, hundreds of thousands of dollars of income that's getting taxed off the chart. Put him into an S corp. We found out what a dentist that works that way and is, as far as a practice or whatever, if they were just strictly working as a W-2, then he paid himself out of his S corp, has a W-2 from that. Profits come over to his return, no self-employment tax, much less comes over to be taxed on his personal tax return, saved him tens of thousands of dollars.
Where's the extra money going?
What do you mean?
The money he doesn't get as being the sole stockholder, where does that profit go?
Well, some of it you're going to have as retained earnings and things like that, but you're still going to have it come over on a K-1, but you're not going to be paying self-employment tax, and it will be a lot less because the options that he has. And then we were able to set him up with a lot of the things that we'll see here, but we talked about SEPs and simples and stuff like that. He was able to really do some nice things for his employees that really saved him money on his taxable income. So, okay. So that's where when you get to a certain threshold. So if you see somebody that's making net profits over $100,000 on their Schedule C, chances are you got to start thinking about maybe changing their business identification. And don't let them go do it with a online service that they're going to pay $2,000. Right? Okay? Far less than that to go through us. The only thing we don't do is put the ads in the paper. Okay? All right? But basically, we'll do everything else, and I think Maria charges $250 or $300 or something like that, and it can cost you $2,000 or $3,000 to do it with a lawyer or through an online service. So, all right. Besides that, it's job security for Liz because she's the one that has to do all the bookkeeping for it. So. All right. So that's the first part. Now, income. Obviously, we talked about the Schedule CEZ. This section is basically one little line. Maybe we got 1099, maybe we don't. You don't have to have a 1099 necessarily to have sales. We'll talk about some of the couple of the different ones that you could add. So in here, the Best example, I have a gentleman that does snowplow. He gets 1099s all the time from the churches. Why would they do that? What's that? Yeah, 501c3 or 501c, whatever number they are. Probably need to keep track of the dollars right to the penny so they can keep the tax exempt status. Some of the other places that are businesses, maybe writing them a check or here's an envelope full of cash, whatever it may be. He just has to keep track of it for me. All right? The other thing that can show up on this, as it talks about, is the statutory employees. The other one here, if you take a look at page where to go? Take the page 517. You can see there that it talks about payment card or third-party network. I have clients that their sole proprietor business is buying and selling on eBay. Okay? A couple of them should have a warehouse because they no longer have a garage, dining room, or third bedroom because they aren't doing very good on selling the stuff after they buy it. But what does eBay use as its payment method most of the time? PayPal. So you'd see a statement from there with PayPal with the different months on it. And just like you see there, and they give that to you, you have to bring that in because obviously if there's a 1099, where's one copy going? Yeah, to the IRS. So you got to report it. All right. The IRS in New York State have gotten a lot more stringent on recording these things. New York State especially because, when internet commerce started to really take off, they were having a heck of a time figuring out how to collect sales tax. Sometimes you'd order something, you wouldn't pay sales tax. Well, New York and most of the states got smart. And wherever you're living now, you have to pay sales tax because New York State was starting to say, well, if you're not collecting sales tax and paying it to us, you can't do internet business in our state. Obviously, population. Okay. The one that's the hardest to do this with is always Craigslist. Okay. Not really the transactions on there, but if Noelle sees my post on Craigslist about my guitar that I'm selling, and I sell it to her at a profit, what should I be doing? But what else should I be collecting?
Sales tax.
Sales tax. And paying it to who?
State.
Yep, to the state. Okay? So, those are things that we have on the little questionnaire that is in our waiting room that ask about, did you purchase anything where you did not pay sales tax? What they're looking for is the big fish.
People ask me all the time, what does this mean?
So, well, what's the other one that's on there? Yeah, Indian reservation. Anytime that you're avoiding paying sales tax in New York wants to know about it. Okay? I have about 6 clients that come in every year with the sales tax that somebody should have collected that they didn't pay. Well, those are also, what's that?
They do that?
Well, they're also my clergy returns. So obviously it's the 11th commandment. Thou shalt pay sales tax in New York.
I always put no.
Okay. You always put no?
Did you buy anything? No. You buy anything on the internet?
I never left the
No.
state. No.
A friend of mine always puts, I don't know, he puts like $300 in tax. That covers something, he just pays it.
Well, that's kind of.
Well, he just wants to be covered.
Yeah. But, most things, if I go down to Pennsylvania and I buy a car and I bring it back to New York, what's that?
You got to pay tax on it when you register.
Yep, sales tax when I register it. So, most of the systems are set up that you can't avoid it. Okay? Speaking of sales tax, okay, the other thing that I saw go by, SS4. If you're a sole proprietor, you don't necessarily need an EIN number unless you're going to have to be paying sales tax or you're going to have payrolls. Okay? That SS4, to get that EIN, the employer identification number, actually is online. It's a great little process now. You can do it online in about 20 minutes. So you don't have to fill out the form, mail it in, then wait for somebody at the government that's making $110,000 a year to get it off their desk and mail it back to you. You can just do that online. All right. Okay, so we have all of our income. Next thing we have is returns and allowances, okay? If I have a defective product, I'm selling Mary Kay, and one of my products causes somebody's hair to fall out, okay? Then I would have returns. I can put that on there. What's that?
I said that you have a problem.
Yeah, okay. Now, line 4.
Don't worry, because I got that.
Line 4, we have, what's that, Noel? I'm sorry.
Oh, no.
Okay. Line 4, we have cost of goods sold, okay? Cost of goods sold, we have our inventory method. We just have to decide which one we're doing. Most of the time we'll have cost. Please don't ever let anybody change their inventory method value, okay? Because it becomes a headache, so, all right. Inventory at the beginning of the year, nice enough on the software that, where would that number come from if you did their return last year? Inventory at the end of the year. So whatever previous years, it'll come right up. Purchases, if I buy any inventory, all right? And then whatever that may be, okay? Obviously, we cannot claim personal use. So if I have my favorite shade of lipstick and I'm taking it out of my inventory, I cannot use that as cost of goods sold because I'm using it for personal use, okay?
How would that work though as far as your inventory though?
You don't add it in for purchases.
Then you back it out.
the
You back it out,
purchases,
yeah. So basically, you're subtracting your purchases. So you can't add that to your inventory because your purchases are at wholesale.
Well, that's what I was thinking. I just didn't know if there was-
Materials and supplies, don't see a lot of that, okay? Again, if I use a Mary Kay business, my materials and supplies would be if I'm buying all the different components to make the Mary Kay, which most of the time you're not seeing. Now, if I'm making birdhouses, I might put my wood and my nails and my whatever it is in there, okay? All right? And then we have the inventory to get our cost of goods sold. Once we do that, it goes back to page 1. Now, we're going to see later there's a section called supplies. We'll kind of distinguish between the two. You know, cost of goods sold is those things that I'm actually selling. Supplies, and again, the reason I use the Mary Kay business, other than my wife doing it, is because I usually speak to about 30 to 40 Mary Kay women throughout the year to have them do stuff. Supplies, great example would be gift bags, okay? Gift wrap, things they're using to package or, you know, present or sell or whatever their material, catalogs, different things like that, okay? Because it's really not in their inventory per se, but it's supplies they use to sell the goods, okay? So that carries back over to the front, and then we get our gross income. Well, once we have that, that's when everybody looks up in the little blue box in the top left corner, and it's the panic button. Because if I use this return right here, and I say, okay, whoops, I had $50,000 in sales, okay? And it turned red to the tune of $12,706. So, okay. What's that? Well, yeah, you could. Okay. That's why when you're a sole proprietor, you want to figure it out because now all of a sudden your tax is through the roof on things. Okay. So we're going to look at our expenses. Actually, let's take about 5 minutes and then we'll look at our expenses. Okay. And we'll go through this. That way we got this. Part 2 of the Schedule C, we have our expenses. And like I said, it looks very, very similar to what we saw in expenses for the Schedule E, for the rental property. Advertising, you know, I'm spending my $10 getting my business cards from Vista. Okay? Or I bought an ad in the paper or the Bees or whatever it may be. Car and truck expenses. Again, we can keep track of our miles for business. All right? The problem's going to talk about a party method. Not really a fancy IRS term, but basically what that is, you travel around and you go to somebody's home and have a party, and that's the way you sell your product, your direct sales. Right. Okay. You doing very good?
No, that's just.
Okay. Party light, yep, same thing. Because of your miles going around, you're delivering product. If you're going to the post office to mail it, you went to the office or the office supply place to pick some up. Those are all miles for your business. Okay. Obviously, it's very good to keep track of the mileage because 57.5 cents or 56, whatever the rate will be. Okay. The other method that you can do on that is actual expenses. All right. So you can keep track of every gallon of gas, every oil change, every registration, all the different things. Okay, that you do to operate your car. I guarantee if your car is in decent shape, 57.5 cents is A, much easier for all of us as tax preparers, and B, is a much better deal. Now, the only difference would be, and a lot of times I'll see it pretty close, is if you, like I talked earlier about somebody that has a tractor trailer over the road. There's a maintenance and upkeep on those, especially when he has something like an engine go out and he's 1,000 miles from home. You don't have much choice, and you got to deliver the goods, so the engine's got to go in. All right? So in a case like that, actual expenses are probably better because that type of repair you're going to get to capitalize. So you're going to put it back in because what's going to change on the value of the truck? The basis. Yeah, because you kind of increase the value because now it has a new engine instead of the old blown engine. All right? So sometimes on an instance like that, but most of the time for business, you know, you're driving your car or you bought a truck or a delivery truck or whatever, mileage is going to be much better. But you can always do the other. Okay. Commissions and fees, if I have somebody who works underneath me, and I give them 10%. Okay. Probably what am I going to issue them? Yeah, 1099. Make sure. Okay. Contract labor, there's where I talked about that, those 1099s, mover, whatever it may be there. Depletion, we won't worry about. Depreciation, here it comes again. We'll talk about it later, but again, it's an expense. It's where you're allowing yourself to take a item that you have purchased for your business and either take it in what that little number, and what's that number up there?
179.
Yep, what's a 179, Noel?
To fully depreciate equipment used for the business in the first year.
Yep.
Up to 500,000 unless it exceeds $2,010,000.
Yep. So basically what it is Section 179. First year I have a business or first year I buy this thing, it generates a huge amount of revenue. Rather than just get to use a little bit and have to use the rest over the life of the product, I can choose my 179, take it all in the first year. Okay? So it cost me $100,000, or excuse me, it cost me $1,000 to buy this really nice helium tank. Okay? And because I have this super helium tank, I sell a whole bunch of balloons the first year. So what am I probably going to do with my very nice helium tank? Take it here and I generate revenue. Okay? Instead of taking my helium tank and chopping it up over 5, 7, whatever many years I may use it, I'm going to say, hey, look at all these balloons I sold the first year with this fancy tank. I need to put an expense against that so I'm not paying tax on that income. So I'm going to take the Section 179. So I take it all up front. Okay? So there's your second lesson on depreciation. So depreciation is not that hard if you just understand that it is an expense and you have to decide when you're going to use it. Okay? The hard part would be when I make you learn how to calculate and all the conventions and all the other stuff. So. Employee benefit program, other than line 19, which is pension and profit sharing plans. So we can talk about that. What would be an example of employee benefit program?
Adoption credit.
Mm-hmm. Cafeteria plan. You know, everybody, you know, the old-fashioned cafeteria plan. What are you matching or paying for your employees? Okay? Maybe I'm giving them an HSA. All right, okay. Insurance other than health, okay?
Life insurance.
Yep, insurance, anything, or I carry for my wife on our insurance, home insurance, I carry a little umbrella policy because she's going into other people's homes. She's going to places of business like trade shows and stuff. Don't want something to happen where somebody blames her. It's a way to protect her from liability, okay? That way I don't have to put her into an LLC or PC and make her own corporation. We have something that'll protect us, okay? Interest, mortgage interest. This is not the mortgage interest that you pay on your home. We'll talk about that when we get into the home office. This is mortgage interest. I bought a building, bought a warehouse, something like that. Something that I'm doing with that for my business. Other interest, if I have a credit card, okay, that is strictly for business, it is in the business's name or a DBA, then I can use that interest on that credit card, okay? Legal and professional services. Well, yeah, your accountant, or you're paying that guy $3,000 to set up your LLC, okay? Office expense, exactly that. Things you would use in your office, pencils, paper, whatever. Now, the other thing with office expense, this is where we're starting to see a lot more of computers, tablets, things like that. Typically, a computer in this day and age and software doesn't have more than a year's useful life. It's either done last or it's obsolete, depending on what your business is, okay? Office expense, a lot of times where I will do this with this is somebody's buying a small tablet to put the square in to run credit cards. To me, that's an office expense, okay? If they're buying a desktop that is going to be used for computer design, well, that's a $3,000 or $4,000 computer. I'm going to depreciate it, okay? But buying that little, $300, $400 tablet so you can process credit cards while you're selling your birdhouses out in the thrift place, what's that place in Clarence? What is that? The what? Antique World, yeah, where they have all the garages with people selling their junk. So, sorry, they're collectibles. Okay.
No, that's true.
Okay. All right. Well, no, one person's junk is somebody else's collectible. So, okay. So that's what office expenses. We talked pension and profit sharing versus the employee benefits. Rent or lease. If I'm a snowplow and my truck goes down, I got to rent another truck so I can continue to do it because we had a 8-foot snowstorm. Hey, even though it's not the truck I'm depreciating or using on my business, I can take that. Or if I'm renting property or a studio or whatever it may be. Repairs and maintenance, okay? There's a great little description in here. And oh, by the way, quick finder, if you ever want to read through this, Esther reads these things for free time. She finds things in here and you're going, where's that at? So, it's great for the Schedule C because it breaks down lines and gives a little bit of better descriptions of everything. Repairs and maintenance. It says, deduct the cost of repairs and maintenance, including supplies, labor, and other items that are not required to be capitalized. Okay? All right? Because repairs versus capital improvements. All right? So when I was talking about, fixing my laptop, that's a repair. I have a tractor trailer that is part of my business and I put a new motor in it. It's not just a repair. Okay, I forget how much that motor cost, but it was unbelievable.
Probably about $50,000.
Well, that might have just been the motor. I forget what it cost him to get it installed so he could finish his job. So, yeah, that's not a spark plug where you're unscrewing and then screwing it back in. So, all right. So we have that on there with the repairs and stuff. Supplies. Again, I get back to this when we talked about cost of goods sold. It makes a point to say that not included in part 3. What's part 3 is cost of goods sold. Okay? Supplies are really those supplies, things you're using to sell your product. Okay? Things you're using to sell your product. Now, if somebody is in a business that maybe does not have inventory, maybe your supplies could fall in there. Okay? But that's probably pretty rare. Right? Okay? But then you don't have inventory anyway. Yep. Okay. All right. Now, taxes and license. The one thing to remember that first time everybody sees taxes, they usually think sales tax. Depends how the sales tax is handled. Okay. If in my gross sales I'm including sales tax, then yeah, I can subtract it out there. Because really, what is sales tax? It's a pass-through. I collect it and then give it to the government for them on my product. Okay. So very rarely we see anything in there with taxes, but sometimes they, and again, I go back to the Mary Kay on the statement. Mary Kay, when you order at wholesale, you pay the sales tax on your order. They collect it and pay it to New York State so that none of the reps have to be registered to pay sales tax. They don't have to worry about it. Now, if I have taxes on there that I paid tax on something and I've either used it for personal use or I've given it as a donation, then I've never sold that product to recapture that sales tax. So that becomes an expense for me. So that's where I put those taxes in. Okay, does that make sense? All right. Travel and meals, we've talked about this before. The IRS has determined that you must eat. Okay? And again, if I go to Tim Hortons and I have coffee and donuts with a potential client, or I am an S Corp and I sit down with myself and talk to myself, okay? All right? I can write those things off as business expenses.
What if you're traveling and meals included?
Traveling in what way?
So in the way that like your business is happening for business, like you're leaving or like designated area, going like both ways, meals included in travel. Like,
Well, if you're on a per diem, because then you're doing like we've talked about with over the road. Yeah, that's all included in a per diem. If you're doing a per diem deal, then the meals are included in there. But, you know, that's if you're really truly like a DOT over the road that you're away from home. But most of the time, you have your travel and meals there. Okay? All right. But yeah, most of the time, depending on what you're doing when you're doing with your meals and travel, if you're away from home and over the road, things like that, yeah, some of those meals, yes. Okay? If you're staying as, near your tax home, then chances are your meals are not going to be written off for yourself. Okay? Now, utilities. This is always one, too, that everybody just first thing you pop in your mind with utilities is, they play Monopoly. It's water, what is it? Water, electricity, okay, and gas. Those are the utilities I want you to think about, because if you're renting somewhere, the rent doesn't include utilities, okay? What I do with anything else is that I will put it on the next one down. Well, excuse me, there's wages there, and then there's your employee credits that you were talking about, Noel, if you go in there, okay? All right. Other expenses. Actually, this comes over from Schedule 2. There's a little Part 5 that is other expenses. This is where I put cell phone, internet, because when I put on there, I put cell, and then I say 50% business, so that they know I didn't give the person full credit for their entire cell phone. And usually my question is, do you have a cell phone that's used for business? Yes. What is the cost of your line? Well, we pay $200. No, not your family's plan. What is your line? The one that's doing the business. Okay, then how much of those calls are for business? Almost all of them. So, your wife doesn't love you and she never calls you? Okay. You haven't called your mom in the last month? You can't say 100%.
What if you had a separate line?
If you have a separate phone, that's different.
Drug dealers always have two.
All right. I can see, Brian, the first return that you're going to do is going to be, let's see, what have we determined? You're going to be on line 21 with illegal activities. Okay? What's that?
Oh, you wouldn't thought that.
He'll have some cost of goods sold. Yes, yes. Well, they'll catch up with him because he's probably not charging sales tax on his product.
Oh, no.
Yeah. Okay, I gotta keep it around. Okay, so a lot of utilities. Gotta be laundering that money. So, all right. Internet, perfect spot for this. Publications, donations, things like that. Anything that doesn't fall in those categories that are on the other part of the Schedule C. Internet, the way I typically handle it, same thing. Do you have internet in your house? Yes. Okay. Are you using it for business? Yeah, almost. That's all we do. So you never did any of your Christmas shopping on Amazon? Well, once in a while. Okay. So you got to kind of ask the right questions. I will give them a little bit more credit if they have a business where they have to have an upgrade or higher speed coming in, because then that's really been mandated by their job. But if they have a higher speed just so that their son can play Call of Duty or whatever the latest game is, no, it's not for gaming, it's for work.
How do you know the difference? Because they have the highest speed that we can get.
Typically what it'll be so that they have record and so that if they're a electronic commuter, as they call them, then typically they'll have two lines coming in because they may have a personal and business so that they can get higher speed. So it's real easy to distinguish. I have several clients that are that way, and it's real easy because they say, here's my business internet because I have this high speed so that I can do all this transactions and there's no lag.
And how would it work if they have a mobile hotspot?
Same thing, same thing. Yeah, they can, all that. But again, I don't believe anybody has 100% use. Okay. Now, if I ask them that they're shopping for Amazon, usually my next thing will be, well, I am a 18.5, 34, 35 and a dress shirt. So if you can say that you're buying shirts for your accountant, then I'll let you write it all off. And seeing that Christmas is so close. So, all right. The business gifts are 25. Yeah, well, you could do that. Yep, $25 gift cards. So, all right. Okay, so that's all the other expenses that are on there. Okay, so we've pretty much covered chapter 5 and 6. All right. Now, page 6, 4. Well, hold on one second here. Yep. We're going to go back and do one little thing, okay? If we go back to Schedule C, page 1, we have determined our total expenses. So we have, right now, we still show our profit, okay? The next thing we get to do is see if we have a home office, okay? And I stress the word office. It's not a home bedroom. It's not a home dining room, okay? As much as people will say to me, and I even had a client one time to prove that they were using their dining room as an office, brought in a picture of their dining room with the table covered in papers. I said, you mean you'd never sit down and eat at Christmas or Thanksgiving at that table? She goes, well, yeah, I cleared off for that. It's a dining room. You ate in it, okay? It's not an office. If you notice on here, there is two methods. You can do the 8829, which we'll talk about in a second, or you can do the simplified method. I have a 1,000 square foot home. 100 square feet of it is used for business. The going rate that the IRS, kind of like mileage, is $5 a square foot. Okay? However, that would be a negative 500. I had no other expenses. Why doesn't this show a negative 500? You can't go negative on your business income because of your home office. Okay? So that's why you get this tentative profit or loss, and then this is after it. So don't panic when you get done going, well, they had a home office. They shouldn't have had a profit. Well, it'll take it to zero. It's kind of like a non-refundable credit. It'll eat up and it's done. Okay? So it won't ever make it negative.
Okay, I got a dumb question.
Never a dumb question.
Now, what if, going back to the home office,
Mm-hmm.
say you have a home office,
Mhm.
where you have the room that's dedicated for your office.
Mhm.
But you have people coming to town, like family at Christmas, and you use that as, just for the holiday, as a sleeping quarters.
Give me in a bedroom.
If there's not a bed in there, you let the kids sleep right on the floor.
It's like my parents have an office because they have their own business.
Mm-hmm.
One room dedicated to paper stuff and all of that.
Mm-hmm.
How if we ever do sleep or spend the night there, we throw Pat out on the floor in their office.
That's different because that's temporary. I have people that sit and argue with me because they have a day bed.
Well, that's what I was gonna say. We have one.
We have
in our
full
office.
time.
Well, it's full time, so that's kind of more of a permanent. There all the time.
Right.
You know,
Well, it's normally, it's a
But
function.
they don't have a business. I don't know why you're fighting.
No, I'm just asking.
well, what I'm saying is you know, what is the general use of the room? You know, what you described and sleeping in there temporarily, yes. Okay. A dining room where you got papers all over there, I mean, you know, but if you have a room that is a separate room, that's what you've designated as a home office, that's different. Okay. To give a little more sense of it, if you go back up to line 30, you can use, and we'll see this in the problem that we do, you can use an 8829. Anybody remember where we saw the 8829 before? I said we'd come back to it. Where do you keep your personal itemized? Yeah, remember when I talked about taxes and property taxes and said we'd come back to it? This is why, okay? So if we go to our 8829, basically what we have, and this is the other thing that drives me absolutely nuts on this thing. I got so, because the simplified method came up about 2 or 3 years ago, they started using it. I was so used to doing an 8829. Anybody notice what the difference is? On the other one, you list the square footage of the house first, and then the office area. This is the total opposite. So if it took me the longest time to get used to typing them in the other direction, because I get done, I'm going, there's no way they can write off that much for their office. Yeah. So you got to kind of, but you can see on this one, very similar, but we're actually going to calculate our actual expenses. Now, again, just like I've talked about with mileage, chances are if the IRS is setting something up and giving you a flat rate, it's probably going to be a good deal. Okay? All right? So we have this. Obviously, there's a little things that distinguish if you have to use it for daycare. But when we get down below, we have, you all right? Okay. We have expenses that we can use on this, and it goes against our income. Okay? We have the words direct and indirect. Direct means it relates directly to the business. Indirect on the home means it's just a portion. So once we calculate up above our percentage of the square foot or the portion of the house, anything that we put in indirect, so homeowners insurance, not for personal, but I can do it for business. So if I have $500 there and it allows me to write off 10%, $50 is going to show up. Okay?
What about casualty losses? Isn't it just considered a business expense anyway? So wouldn't you put it in the direct for business or is that?
Well, yeah, that's the case. Yeah. So,
But I
okay.
mean, so it's not for.
I'm sorry, what's that?
So it's not for a business. So casualty loss is considered to be a business expense. So would you put it?
Well, you just said something totally different. You contradicted. You said casualty loss is not for your business.
You can have a casualty loss. You write it
Yeah,
out
as part of your house. Yep.
Business expense because it's not no matter because you can
And
have that loss.
you're doing apples and oranges. Because if it's a casualty loss, is it casualty loss on the house?
On the house.
Okay. So where are you going to put it at?
But I thought because it's a business expense because you can create an NOL from it. You could
Okay.
have a personal NOL.
So if my house burned down, does that mean that the entire house was my business?
No, but I'm confused because I'm told it's business expense. It's not considered. You couldn't create an NOL personally from casualty loss.
But again, if we're talking about the house,
Right. The whole thing is not going to be your business.
so that's different. If it was something where, yeah, if I have something in the house that burns down, you know, say that I have all my inventory in my garage, then I can take that whole direct, I'm not going to take as a portion. So if if it's a structure, say that just the garage burns down and that's considered my business, then yeah, that's all direct. But if I had my whole house burned down, then I would have to do it as indirect because I only had that little portion designated as business. You know what I mean? So it's kind of, you got to follow what the purpose of the house is, okay? Has mortgage interest, property taxes on there. Again, that's why I talked about this 8829, all right? If we use a portion on our business, what do we got to do with the rest of it? I only get to use the rest on my personal side. Can't use them double dipping, okay? So that's why when you look at the Schedule A, it talks about real estate tax remainder from Form 8829, okay? So we have that on there. So that's where on that Schedule C when we have that with our home office, okay? You see all these different things here, insurance, rent, different things that you can do that, if I pay rent for an apartment, okay? But how much of the rent am I going to get to write off? Just a small portion, okay? All right. Repairs and maintenance or other projects that you do. I've had one client argue with me over the new bathroom he put on adjacent to his home office. That he wanted to do it. What's that? I'm sorry.
You have to be in the home office, right?
Well, it was adjacent to the home office, as I was saying, okay? So he was writing it off and trying to write it off that it was for his clients. I said, so nobody else uses the bathroom? Well, we only had one in the house before, so if it's occupied, then sometimes somebody will use it. Come on, really? So, you can't. So, all right. Okay, so we have on there, talks about all the other things. Now, depreciation. You can take the depreciation on your home, okay? So if I have a $100,000 home, $100,000 home, and what's the value of my land? 10%, yep, 10,000, okay? There is a basis of my building, all right? Now, won't calculate the percentage, but what I can do, what's it say right up here? Enter everything on this line, then F9 on line 40. Okay, we'll see what it does. And then Mark's favorite, there's a worksheet inside the worksheet, okay? So once I'm on that, it's a house I bought back in 2005, okay? All right. And, okay. What's that? No, you just do makers.
Oh, it's
Okay.
I'm so sorry.
Yep. All right. Okay, so I have all of that in prior depreciation. Now, why is it not giving me a depreciation amount? I just did all the calculations. Nope. What was the other thing I told you about the fact on the simplified method? I have no what?
No profit.
Yeah, I don't have profit to put it against. Okay, so if I do go back to my Schedule C, and again, that's the thing with the home office I want to stress, if they got a loss, you can't add to the loss of the home office, so it's kind of futile to do it, okay? All right.
If they don't have a loss, isn't it almost better to not put the home office in so they can get the depreciation? Because if they put the home office in and it brings it down to zero, so they don't have a profit, they don't have a loss, then they can't depreciate.
Well, this is a depreciation that we're doing on the house for the home office, not a depreciation that would be something we could do a negative.
Okay.
So if I'm depreciating my computer, that can make the number negative.
Okay.
My home office, depreciating my home, cannot make the number more negative or whatever you want to call it, okay?
So you advise people most of the time, I shouldn't say most of the time, but in circumstances like this to not depreciate their home?
Well, What I'm saying though is if I do this where I have $10,000 in profit, and where's my 8829? And I have, let's see, we're going to have a pretty large area, okay? All right. So once I have that, okay, and okay. All right. So you can see that I got a depreciation once I had a profit, but it's only 3.6%. It's only $327, okay? All right? Because the business basis of my building is pretty minimal because it's based on the 10% from up above. And then depreciating that, and it's, okay? So now we're kind of all said and done. Let's say that we paid, let's see, we pay $5,000 a year in property taxes, and I have a $600, and whoops, I got on the wrong one. We'll say $5,000 in mortgage interest and $5,000 property taxes, okay? So I have my home office now with everything on it, okay? $1,387. Maybe that's pretty good, okay? All right, but what was the size of the house I did? 2, okay, right. So I would have about 200 square feet times 5, so about $1,000. So in this case, it's a better deal to do it. All right, but 200 square feet of a 2,000 square foot home, that's pretty good size. I'm guessing that you have a 2-car garage that you run your business out of and nothing else happens there. Okay, and if somebody says, well, yeah, that's what I do. I said, so where do you put the Christmas tree in the off season? In the crawl space above the garage?
No.
Oh, okay. Listen to you two scheming, okay? All right.
We know we do have, oh, it's part of our back.
When the house is sold, you gotta pay the piper on that depreciation, huh?
Not on the business. Rental property, yeah, rental property, yes, but on the business, you do, but it's not as severe as you think about with the rental that we talked about, okay? All right. Okay, so that's depreciation, excuse me, home office. If you go to page, okay, so we talked about the home office. If you go to page 632, so chapter 6, page 32, this is the clergy section, okay? Why this clergy section is only this big, I do not know. Obviously, you're supposed to add some notes, okay? All right. Maria informed me that office 10 is empty now, so I can get in there. I will hope that I can find, because the last time I was up there, I did not see it. I hope I find my clergy sheet so I can make copies. Because if I don't have it, I'm lost. Because you just have to be so careful with them. All right? It talks about all the different things. We've talked about the fact that most clergy have no FICA, which is withheld, and self-employment. Most of their compensation comes through their housing allowance, which is handled different. They then may have a Schedule C. The reason they would have that is if they're doing weddings, funerals, seminars, you know, whatever it may be, counseling on the side that they're paid. So there's a lot of variables to a clergy when you go to do the return. And there is a very stringent hierarchy of what sheet you put in first. Okay? So I will get the sheet for that so we can go through all that. Because if you don't and you miss a sheet, once it's calculated and you go back and try to make the correction, it won't recalculate itself. I don't know why, but you just want to make sure you do it in order. Okay. I learned my lesson the hard way. All right. Also, if you do not do a clergy right because of the way their W-2 looks, you can have the thing swing from them owing $2,500 to a refund of $2,500. It's not like it's just a little bit. What's that?
So then there's 3 to 2 years when they have.
Yes. You know, then all of a sudden you got to go to them and say, you know that refund that you had? Now you got to give it back. Plus, you got to give another $2,500 to them. So it's not like you just owe $2,500. You owe $5,000.
What do you do? You must run across really complicated cases now and again, or something that you're not sure of, or they're going to take you a long time. Do you ever just send the client home and like take care of it maybe after hours? Or?
Sometimes it will. And, you know, I'm very honest with them and candid. Hey, I want to make sure this is right. I don't want you to have, you know, $1 extra of taxable income. I'd rather do some research and make sure that there's nothing that I'm missing on this. You know, if you're talking about money out of their pocket, they're more than happy. You know, you can get everything else done. And then basically, you know, what I say to them when I wrap it up is say, hey, I'll get this all done. When I call you, all you guys got to do is stop in and sign, and it's on its way.
You must get a feeling for like,
well,
how it's going to work out to begin with, right? And if it all of a sudden isn't that way, you know, you got to go searching through and find out where the mistake was made. Or
well, especially when you get into these with the Schedule C, you kind of get a sense, depending on how the person comes in and how their bookkeeping is. If they come in and they sit there and they just start going, well, I spent about $3,000 on supplies and this and that. You never see a notebook. You don't even see them go to their phone to look at anything. You're thinking, okay, you know, you need to give me some written support. Okay. Maria now has a client that used to be mine, that I was the first one to run across the individual. When he first came to me, I had to get him to do a filing system because he would just bring me the receipts. Well, his filing system was Ziploc baggies. Okay. If you know who I'm talking about, I think I still have pictures somewhere of the first time he brought them into me. But Ziploc bags with Sharpie written on the outside, and he usually brought it in an Olive Garden leftover bag that still had the little oil stains from the olive oil. Okay. But it took me a while to break him to do that, because I, you know, just wasn't going to go just off the top of my head, because he was making some poor business decisions and we need to keep track of stuff. The worst part about it too was he'd take the Ziploc bag and just stuff them in. So his supply thing for Home Depot and Lowe's and whatever else, when you got to the end of the year, you pulled it out, it was like a snowball. Okay. All right. So that was the way, but at least I got him to keep his receipts, and at least they're categorized. Yeah, and I think I charged him for an iron because I'd iron all his receipts. But, you know, yes, you're exactly right. Some of them you just kind of go, something's just not working out here right. And it happens to me, it happens to Chris, it happens to Esther. You know, there's some times that you just got to be, hey, you know what, for your best interest, I need to spend more time on this. And it needs to be on uninterrupted time so that I can really look at it and say, we did the right thing. I had one the other day at the corporate office. It took Chris, Maria, and I, all three, to stare at it for 5 minutes till we figured out what it was doing. So, yeah, I mean, you know, it's not that they lose confidence in you when you say that. It's more so that they respect you for the fact that you came out and said, hey, something's not right here. We need to look at this a little better. So, plus, especially if you tell them that this will prevent the IRS from knocking on your door. So, okay. Yeah, because sometimes even with, especially the more returns you do, you start watching something and you realize the little quirks of the software where you got to go check something because, you know, did you hear George today? We got the new software for 2016 tax returns. It was the first version of it. They sent it to us. He broke it. He used it And one of the things he did to try to test it and set it up so that it was like you see right now, because George has to make a lot of modifications, our IT guy. He got in there, started doing something, broke it. Called him up and told the programmer, hey, you need to check this. And they go, oh. So, I mean, we get it, you know, at least hopefully a month in advance so we can play with it and make sure things. Right now, there's something from 2013 that we're contesting with them that their legal department's looking at because we're saying all the returns we did in New York were wrong. And now that, you know, it looks like it's us having to pay the penalty because that's our company policy, when really the software handled it incorrectly. Yeah, it just was an incorrect calculation within the software. So, and, you know, finally we caught on to it because all these returns, we started looking at it. So, all right. Okay. Self-employment health insurance, we talked about that. As I talked about before, self-employed individuals can, however, deduct the amount paid for medical, dental, and qualified long-term care insurance for themselves, their spouse, and dependents. The insurance can cover children who are under 27 at the end of the year, even if they weren't the taxpayers. As I said before, you got to be real careful with this because, you know, in most sense, this means that what is on the return? Just self-employment. So the only income coming into that house, okay, if you have a spouse that works and you're running a business, to be able to say that your self-employment is paying for the entire health insurance of the family, I don't know if you had an audit that you could really justify that. Well, if insurance is not offered, but chances are that's not the case anymore with the healthcare. Okay? Because it doesn't take much of a threshold to have to require even part-time employees to have health insurance. Okay? All right. And if you got questions about healthcare, call Liz. She's very knowledgeable on her healthcare. Okay? Okay.
Why does that go on here on Schedule C?
Which one?
The health insurance deduction?
Remember, it's not on Schedule C. Where did we see it?
Oh, that's Schedule A.
No. Where did we see it? On what page of the 1040? The adjustments to income. Yeah, remember on the adjustments to income? Yeah. Yeah, there with our IRA deductions and our SEP and our simple.
929.
Yep. Yep. Okay. Self-employment tax. Okay. It's great that on 637 and 638 they show the forms. Okay. On those, we calculate and take 92.35% is the first thing we do. Any idea why? 7 point. Yeah. Okay. Anybody have any idea why we take our profit and only use 92% or 92.35? What do employers typically get for paying their employees payroll taxes? They get a what? A credit. There's that 8%. So as self-employed, basically what I'm doing is on my tax return, I'm getting the same credit that an employer would get towards that, okay? Now, that's where our discount comes in, or account, or whatever you want to call it, or a coupon as being self-employed, because it's a privilege that our employer would typically get, but we're our own employer. So we get to reduce the amount that we're calculating the self-employment tax on, and then we take, and the first thing you do is take 12.4% and then 2.9, so 15.3%, okay? Typically, that is a very good number. Net profit, that 15.3, that's basically what you want to start thinking about for estimated taxes. Okay, you know, not knowing what else happens on the return, it's always a good idea. If somebody asks you, well, I've started my own business and I think I'm going to make $10,000. What should I set aside? Are you going to make estimated payments? No, I don't really want to do that because I'm not sure. Well, then each time you pay yourself or you have income, you need to set aside 15%, because that's just kind of where it's a good number to throw out there. Okay. And then what happens on the self-employment tax on the adjustments, we were talking earlier about page 1 of the 1040, that's where we get half of that after we do that, okay? All right, and that's appreciation, self-employment, more stuff. We just covered 5 and 6, okay? Now, it is 8 o'clock. All right, you guys have a choice. What I did with the morning class is I had to go a little past because, like I said, I had extra time. So actually I have a class, the guy in the morning class looks like Ernest Hemingway. So we put him in the commercials. So just didn't have the cat on his shoulder. And the cat with the extra thumb or whatever, doesn't all of his cats, there's like 50 of them living in his house now or something. Yeah, little known trivia. What we're going to do, and by the looks of the schedule, we can then talk about depreciation in more detail, and then we'll spend the next class period, and basically we're just going to work problems, okay? Either interviewing each other or going back and just doing problems. If you guys want to try to do the problem at the end of 5 and 6, you can, okay? There's a depreciation is basically all you're adding. And then at the other one at the end of 6, you have a comparison between actual home office, you know, the 8829, or just using the simplified method. Okay, but yep. It's on page, because there's just one problem at the end of 5 and 6. They're kind of tied together. Barbara Young, it's on page 53 in the workbook. So that's the problem that you can work on. So that way we can do, spend the next class, we'll talk just a little bit about healthcare, okay? It's not a lot you need to know, other than, you know, it's probably going to change, but not next year. But for 2000, it'll still be on the 2017 tax return as it stands right now. There's no way they're going to get it changed. So, all right. The only thing that might be different is there may be no more mandate, no more penalty. So the shared responsibility that you have to pay if you don't have health insurance. Okay. All right. So that's it for tonight. Okay. So like I said, next class, we will spend